oil up 20% this year so far. The International Monetary Fund says the threat of higher prices is a key downside risk for global growth. The IMF's World Economic Outlook released yesterday projecting a 36% increase in oil prices this year. Jorg Decressin is with us now. He's in charge of that report. He's a senior advisor with the IMF. He is joining us from his headquarters in Washington, D.C. Jorg, thanks so much for being with us this morning. We know that yesterday in the report you lowered the outlook for U.S. growth from 3% to 2.8%. That was mostly on concerns about the deficit. But how much do higher oil prices affect those views? How much did that represent in the calculation?
I would say that actually oil prices are the key factor in that calculation. It's oil prices that contributed to a weaker first quarter than we had expected back in January, and that's what caused us to lower our growth forecast.
So, Jorg, I mean, what price can the U.S. economy sustain without seeing the growth estimate move again lower? I mean, we know back in 2008, Americans were paying more than $4 per tank when they filled up their cars, and that did actually change consumer behavior. It slowed it down.
You know, it very much depends on what causes the high price. If the high price in oil is caused, let's say, by robust demand elsewhere in the world, by robust demand in China and other emerging economies or in Europe, then this robust demand will help U.S. exports, while the high prices will depress household real incomes and therefore demand. So there are two effects going in opposite directions. It's a different story if, like now, the high oil prices are driven by disruptions to oil supply, in this case in North Africa. Then the effects are much larger. Now, to give you an exact number is difficult, but we believe that the larger the oil price increase is that is caused by supply disruptions, the larger will be its effect on the economy. And oftentimes, you know, a rule of thumb is that a 10% oil price increase lowers growth in the U.S. economy by perhaps 0.2 of a percentage point.
Well, you mentioned Libya and you mentioned the supply disruptions there, or North Africa in general. I mean, some people say that has been 100% already priced in to oil, and at this point there's a lot of speculation, there's a lot of froth. Do you think that's true?
No, that's not clear that there is a lot of speculation. And what do we know? What we do know is that that production has fallen because basically it has come to a halt in Libya. That Saudi Arabia has made up for this production with bringing considerable excess capacity to the market, but has not fully compensated for it. And moreover, of course, you're right. There are concerns about the situation going forwards, and these presumably cause people to increase the inventories and put a risk premium into the market. But the main factor is a reduction in the supply of oil.
And we know as well that Saudi Arabia does not have that light sweet crude, which is so sought after, which Libya did have. But I want to move on, Jorg, to this deficit problem. We've been talking about it last week, avoided the shutdown, as you know, from being in Washington, D.C. We're on to the next battle, though. How much does concern about the deficit, how much is that showing up on your radar screens, to the extent that, I mean, could the U.S. lose its AAA rating if it doesn't tackle this deficit problem now?
Well, we are concerned about the deficit. In the United States, if you take the general government notion, which is a broad notion of the deficit, then it amounts to about 10% of U.S. GDP for this year. Compare this with Europe, where we are expecting a deficit that is about half as large, at 5% of GDP. So we are quite concerned. This is a lot of debt that is being accumulated every year, and therefore we are calling in this report that a strong medium-term consolidation plan be adopted soon.
So, Jorg, to put you on the spot, which debt situation worries you more? It sounds like you're more concerned about the U.S. than you are about Europe, even in its sovereign debt crisis.
Well, we have different concerns about the two continents. In Europe, we are more concerned about the banking system than we are in the U.S. And in the U.S., we are more concerned about the fiscal consolidation than we are in Europe. It is true, there are some European countries that are really struggling under high deficits and high debt, but they represent a fairly small fraction of the euro area economy.
Jorg, thanks so much for your time.